Okay, in the previous class we discussed about the capital asset pricing model or the first step of the capital market theory, and what are those things we found there, or if you talk in a holistic view from point of view, then what we can say that beta is the sole factor which affect the expected return of a particular stock, or whenever we deal with in a particular market, and basically we are always anxious to find out an optimum portfolio, or basically in general we can call an efficient portfolio. Here always we decide the expected return of that particular portfolio of, or the expected return of that particular stock on the basis of the beta, and already you know that the beta is nothing but it is the market risk, or what kind of risk we face in the market with respect to any kind of market portfolio. For example, whenever in the previous class if you go back, then what we have seen that basically your expected return of a stock is equal to the R f plus beta into R m minus R f. So, here the whole theory was referring beta is the sole factor, which determines the expected return of the stock, But gradually what we can see that or when we can say how this beta is calculated, the easiest way or the popular way of calculation of the beta is whenever we regress between the individual stock and market portfolio. So, what basically it means? It basically that the expected return of an individual stock is a function of the market return. So, if you regress between these two, whatever coefficient, the regression coefficient, that basically is defined as beta, and this beta is the significant variable which always determines the expected return. In this context, what here we are trying to show, or what we are trying to determine, the capital market theory, the basic soul or basic theme of the capital market theory is to find out those factors, or to find out those factors which can affect the expected return of a particular stock. So, therefore, in the previous class what we have concluded, the limitations of capital asset pricing model is that to find a particular market portfolio which is a better proxy, or which portfolio basically we can define as the best portfolio or the optimal portfolio, where we can maximize our return with a given amount of the risk. Another limitations whatever we have, some people have argued that beta may not be the sole or unique factor which can affect the stock return in a particular time. Maybe there are some other factors we should take into account to examine or to determine the expected return of the particular stock. So, to argue these things, and after arguing and after exploring certain possibilities, the other people have tried to find out the factors which can affect the stock return at a particular time. In this context, the theory called the arbitrage pricing theory has been developed. So, here before going to discuss about what arbitrage pricing theory talks about the expected return of the stock, let me discuss what do we mean by the arbitrage. If you ask what is the meaning of arbitrage in a financial market, or more specifically the stock market. In general, if you see that if somebody is getting some return without any risk, then we can say there is some arbitrage opportunity is prevailing in the market in that particular time. How it is possible? It is possible whenever the price of a particular asset is not uniform across the various markets available in that particular period. You take the example, if you have taken the position both in Bombay Stock Exchange and as well as the Nasdaq Stock Exchange, and that particular stock is traded there and as well as in Nasdaq. So, let there is a different price differential between these two exchanges about this particular stock. Let the price of the stock in Bombay is 50 rupees and the price of the stock in Nasdaq in 70 rupees. So, in that time what the investor can do, immediately they can buy the stock in Bombay Stock Exchange and they will sell it in the Nasdaq Stock Exchange. So, at a particular time they will pay 50 rupees and they will get 70 rupees. So, in this context what you can see that if there is no uniform price without any kind of extra risk what the investor is going to take, he will get some extra return from the investment. If that kind of situation prevailed in the market, then what we can say, in conclusion what we can say, there is some arbitrage opportunity is prevailing in that particular period in this particular market. Here what in this context we can say, or in general in totality what we can say, that basically if there is no law of one price, if the law of one price does not hold good, then we can say that there is a chance of, there is a probability of arbitrage opportunity in the market. And what do you mean by the law of one price? Already I told you that the law of one price means the price of a particular asset in a particular time in various markets should be same at this investment process. If this is not happening, then there is a big chance of arbitrage opportunity in the market, and of the investors can earn some extra amount of the return without taking any kind of extra risk. So, that is what the arbitrage is talking about, and taking into account this particular concept into the mind, the researchers have tried to explain some certain theories or some certain factors which can also affect the stock return or the expected stock return in a particular time period. So, therefore, the concept of arbitrage pricing theory has been developed. So, if you go through this arbitrage pricing theory, there are certain assumptions again this arbitrage pricing theory takes. The first assumption is capital markets are perfectly competitive. Investors always prefer more wealth to less wealth with certainty. The stochastic process generating asset returns can be expressed as a linear function of a set of k factors or the indexes. You just minutely observe those assumptions what this arbitrage pricing theory is taking. You go by this first assumption what it talks about. It talks about the capital markets are perfectly competitive. What do you mean by this perfectly competitive? We already know that perfectly competitive means there are enormous amount of buyers or enormous amount of the sellers will be available. If there is stiff competition between the different buyers and sellers, then what will happen that there is a perfect price discovery can prevail in the market, and always there is a market clearing mechanism will work there. That means, the demand will be always equal to supply in that particular time, because equilibrium means always we should feel that the aggregate demand in that market should be equal to this aggregate supply. But here the question arises, whenever we talk about this competitiveness in this particular market, and here we always refer to number of buyers and sellers, and as well as also we have seen that we should also take into account some sort of transaction cost what we bear in this particular market to go for buying and selling in a particular time. So, therefore, what we can conclude that in a capital market or in a any of the markets whenever we talk, if there is a general equilibrium or whenever there is equilibrium position is prevailing in this particular market. So, here undoubtedly we can say that there is no discrepancy between the demand and supply situation, and there is a perfect price discovery which is prevailing in this particular situation. Number 2 is a general assumption what everybody takes into account whenever we derive any kind of theory. The second assumption talks about that investors always prefer more wealth to the less. That means, all the investors are the rational investors and they all want to maximize their return, and they always prefer more to less, which is the general sense of the common man and as well as the common investor. They always want to maximize the return, that is always there in the backup of their mind, that if I am getting something more in the market with some level of the risk, then I should switch over my investment to that particular asset instead of investing the asset where I am investing now. So, therefore, this is the basic assumption always we should take, that all the investors are rational investors, therefore, they always prefer more to less. Then the third point is, it talks about the stochastic process generating asset returns can be expressed as a linear function of set of k factors. What does it mean? Already in the introduction what I told, that some of the researchers have argued that it is not the beta which affects the stock return only, or beta is not the sole or unique factor which can determine the expected return from a stock. It is basically some other factors which also play the significant role. So, these other factors basically in the assumption we always refer it to the k factors. So, there are k amount of the factors, k number of factors which basically talks about or which basically shows the particular factors which affect the stock returns. And another basic assumption, if you remember, it is a linear function. That means, the particular variables which are affecting the stock return and the particular process through which these functions or this particular variables is going to affect the stock return, these are linear in nature. That means, there is no such kind of nonlinear relationship should be existing between these two. That means, what you can say, if you take this expected return of the stock, it is basically is a function of let k 1, k 2 like that k n, and whole function is basically a linear function. The relationship between k 1 to year, k 2 to the year and k n to the year all are linearly related. So, there is no such kind of nonlinear dynamics or nonlinear process will be existing between the different assets with the or different factors with the expected return of the stock or any other asset. So, these are the three major assumptions what this arbitrage pricing theory takes. So, now already what I have derived here or what I have shown to you here in this case, if you see already it is known to you that return from a stock is basically your during a specified time, it is your mentioned E t plus B I 1 this delta I, then B I 2 delta I like that plus beta I k into delta k. This is I 1 I 2 like kind of thing, and finally, one error term should be included here. So, your R represents I is 1 to n and R is equal to return on asset I during a specified time period. Then the expected return E represents your expected return for asset I. Then beta is basically the reaction in asset I's return to movements in a common factor. Delta is basically a common factor with a 0 mean that influences the return on an asset. Then your epsilon term, it is basically that unique effect on assets I by assumption is completely diversifiable in a large portfolios and has a mean of 0, and n is equal to your number of assets what we are going to incorporate into your model. So, therefore, this delta I to delta k, these are the different factors which are going to affect your return of the stock or return of any other asset in a particular time period. Some of the things if you observe here, this is your, we always refer that the expected epsilon I is equal to 0, and also we assume, that means what we can say, the expected mean of this particular term will be 0. Then as well as also we assume that whenever we refer to any kind of estimation process, for example, if you are running this OLS, or we can say this ordinary least square regression, and here whenever we take all those assumptions, in this assumption first of all we assume that the expected mean of the error term basically will be 0. That means, this part basically talks about the particular factors what we are not incorporating. We are not incorporating in our model. If we will incorporate all the variables, maybe there are 1000 variables which are going to affect your stock return, but in practical sense it is not possible. If you recall, I already told you these things in the some of the previous sessions, that always whenever we use any kind of models in econometric or statistical way into the finance literature, always we use this statistical function, and the statistical function basically is different from the mathematical function. If you say that how it is different, how the difference can be distinguished between these two, or what is that difference, then your whenever you talk about a mathematical function, you can write that y is equal to let beta 1 plus beta 2 beta 0 plus beta 1 x 1. This is your mathematical function, and if you run this line, this is basically your beta 0, and this part is the slope is basically your beta 1, and x 1 is equal to the variables which is affecting your y. But whenever we, that is why this function is basically a deterministic function. This function is a deterministic function. But whenever we go to the statistical function, statistical functions are basically the stochastic functions. Statistical functions are the stochastic functions. And what do we mean by the stochastic functions? So, here why we call it the deterministic function, because x is the only variable which is affecting y, which is possible in terms of some other aspects, but it is not possible particularly whenever the behavioral sciences subjects we deal with, or the particular model which incorporates the behavioral part. So, this is not possible in this case, but this is possible whenever we talk about any other thing. So, what do you mean by stochastic functions? In the stochastic functions, it is not possible to identify all the deterministic variable which could have the impact on the dependent variable. So, here how this function, if the same function if you take, then here your stochastic function will be beta 0 plus beta 1 x 1 plus u, and that u basically is your error term, and this term generally reflects the impact of other variables, which can affect y, but it is not possible to incorporate into the model. Therefore, to overcome this problem, we have included one error term in that, and the error term will have certain properties, and the mean value of error or expected u should be equal to 0, and the variance of u should be constant. So, these are the two major assumptions always we take whenever we deal with this kind of analysis. Then go to this second step, which are those variables or the k factors what we are going to incorporate in our model. Here if you observe these factors in general have been identified as inflation, growth in GNP or the GDP, major political upheavals, change in interest rates, inflation and many more. Here if you see that the various factors which could have the impact on expected stock return directly or indirectly. So, those things will be taken into account. But one basic observations if you find in arbitrage pricing theory, that arbitrage pricing theory never talks about the deterministic number of factors which are going to affect the expected return of this particular stock. Either there are 10 factors or 20 factors or 15 factors, those things has not been identified, those things has not been identified by the arbitrage pricing theorist people, that exactly how many variables which can have the impact. In this context, if you remember or if you analyze your concepts, then what you can find that any of the variables can affect the stock return. It can be a company specific variable, it can be a industry specific variable, it can be also a macroeconomic variables. But most of the literatures were not talking about this. But here if you observe that the variables what we have identified, either it is inflation or it is growth in GNP or the GDP or it is major political upheavals or change in interest rates, these are more or less the variables which are related to the whole macroeconomic variables. That means, all the companies are compulsorily are going to be affected by this. Maybe the degree of impact will be different from company to company or from industry to industry, but those factors are the responsible factors which determines the expected return of a stock in a particular time. Therefore, what we can say here, that we have to know how those variables could have the impact on the stock return. You can start with the concept of let inflation, how inflation can affect the expected return of a stock. You see, whenever the inflation could have the impact on the stock return in various ways, but if you observe in the real market or practical market, what you can find, inflation will always, if inflation rate is quite high, then you will find the expected return of a stock also should be quite high. Why it should be quite high? Because the investor who wanted to invest in the market in that particular time, they definitely will have the expectations to get more premium, because already the inflation rate in the market in that particular time is quite high. That is why the real cost what they are going to face, that is quite high. So, therefore, unless they do not get the high return from the market in that particular time, it is very difficult for them to invest in the market. Therefore, their expectation will be the inflation rate would be, if inflation rate would be quite high, then the expected return of the stock also should be quite high. And another logic is, why this inflation rate will be higher? The inflation rate will be higher whenever the money supply will be higher. And if the money supply will be higher, then already we know when the money supply will be higher, it is basically whenever the interest rate would be lower. If the interest rate would be lower, the money supply will be higher, and already we know that if interest rate will be lower, then it is good for the investor to invest in the market. So, the demand for investment in the market will be higher if the interest rate will be lower. So, in that context also we can find, if the demand will be more in that particular market in that particular period, then the expected return from the stock also will be higher. Therefore, what we can say, always we should assume that inflation will have very unique impact on, or always there would be certain impact on the stock return in a real market situation. and this is the linkage through which the inflation can have the impact on the stock returns. Then another factor is basically the growth rate of the GNP or the GDP. Already you know that it is the growth rate. GNP means it is the gross national product, or it is GDP means gross domestic product. Whatever it may be, these are the different proxies for the strength of the economy, or the we can say the growth of this growth variable, which talks about the condition of the economy, or generally always we use this variable also the one of the indicators of the cycle or the business cycle. I hope you must have the idea which are the different phases we go through in a particular cycle. If you see that whenever we talk about the different phases, the phases are like this. So, where it starts, for example, this is one phase, and this starts with inclining trend, and it will reach here, then it starts declining, then finally again it will reach here, then again it start inclining. So, here this particular point we call it the turf. Then this particular period whenever it start inclining, we call it the boom. This is the boom, or we can say there is economic boom. Even this is a very household word in everybody's mind, that how this when we can call it this is the boom. Then finally, it will reach the peak. So, this is your peak. Then once it will reach the peak, it will start declining. So, this phase we call it recession. Then once it is recession, it goes down, and again it will reach in the turf, then again it will be boom, then finally it will reach in the peak, then again it will go down to, there is a recessionary phase, then finally it will reach the turf. So, these are the different aspects, these are the different cycle, and how those cycles have been identified. There are various parameters, there are various indicators through which we can identify the different periods, and one of the indicators is the real GNP or the GDP. So, here what we can see, that obviously always we should expect the return in the boom, or we can say in the boom period in a business cyclic process, the return from the stock or return from the asset should be higher, and in the recessionary trend always we can expect that the return will be lower. But if you see one particular thing, that whenever we talk about the different types of the return or different types of the impact of the business cycle on the return, we can see that when it will be boom, whenever the growth rate of the GDP will be higher, and when will be recession, the growth rate of the GDP will be very lower, or in the recessionary the biggest definition, or the we can say that continuously in the 2 quarters or 3 quarters the growth rate should be negative. Here what generally we can say, that if you identify the different business cycle through any of the indicators, either it is growth rate of the GDP, or it is term spread, or it is default spread, these are the different indicators what we use to measure the business cycle. What do you mean by term spread? Term spread is basically the difference between the long term bond to the short term bond, the return from the long term bond to return from the short term bond, and default spread is basically difference between the return between the high rated bond and the low rated bond. So, in this context what you can see, this GDP is a popular variable which is a better reflected, which basically better reflects this impact or the business cyclic process. So, once we can identify this business cycle or the particular phase of the business cycle, then it will be easy for the investor to decide whether the expected return should be higher or the expected return should be lower. Then another factor is basically the major political upheavals. If there is no political stability, then the country risk also will be higher. If you find the trend, if there is a political instability, then what will happen, that this particular market will not attract the foreign investors. If it will not attract the foreign investors, and gradually it will also lose the confidence of the domestic investor. If both the confidence of the foreign investors and the domestic investors will not be there in the market, then obviously what will happen, the expected return will go down, because there will be no demand in the market for that particular assets. So, to overcome that problem, always we should ensure that there is a political stability is prevailing in the market in a particular time. If there is instability in the market, then what will happen, that it will have the adverse impact both in the short run, in the long run, on the different pricing of the different assets in the financial market. So, obviously, the stock market will be highly affected by that, because the stock investment or the aggregate demand in the stock market also will go down, because of the lack of confidence or the lack of opportunities in this particular scenario. Then another variable basically what we have, that is your change in interest rates. So, if you observe that the change in interest rates, already in the literature what we can say, in the literature what we always see, that the change in interest rate is the most important variable for the investment process. That means, what here we are trying to say, that if there is a change in interest rates, then automatically it will affect the whole investment process. If the investment process will be affected, or the total amount of the investment will be affected, then what will happen? It will affect adversely the growth rate and as well as the expected return of the stock. Because once the interest rate will be more, already what I told you, it will affect adversely the investment, and if the investment will be affected by that, then what will happen, that ultimately it will affect the aggregate demand of the economy, and once the aggregate demand of the economy will be affected, then the investment will be affected, then finally it will affect the growth rate. And if it will affect the growth rate, already we know definitely all the markets will be affected by that. And already in the previous sessions also, to some extent whenever the economic analysis we discussed, we also discussed about little bit the different factors which can have the contributing factor for deciding where to invest, where not to invest. But here if you see that investment is basically the key role, has the key role for the development of the economy, and as well as the investment is totally driven by the interest rate changes. So, if the interest rate will have the adverse impact, the high interest rate will have the adverse impact on the investment, then the whole investment process and as well as the whole growth rate of the economy also will be affected, then the return also will be affected. Then many more, which is the problem with arbitrage pricing theory, it is because it does not talk about all the other variables which could have the impact on stock return. It totally neglected the impact of the industry specific variable. It does not talk about the some other variables which could have like some firm specific variable or the company specific variable, but they could have the impact. In the further session in the multi-factor pricing model, we will be discussing extensively about this. So, this is one of the limitations what the arbitrage pricing theory has. Arbitrage pricing theory says that only there are k factors, but which are those k factors, this is not identified by them. But still it is an advanced theory than the capital asset pricing model, because capital asset pricing model was talking about only the beta is the sole factor, beta is the only factor which can affect the stock return, but which is not the true phenomena, which is not the actual phenomena always whenever we talk about a market situation to decide the expected return of a particular stock. So, already we discussed about these things, but that is why what we can say this how each assets react to the common factor, which is represented by the coefficients of the different factors whenever we run the regression with the expected return of the stock. Each asset may be affected by growth in GNP, but the effect will differ, already I told you, because the impact of the business cycle or impact of the growth rate of the economy on all the assets are not same. But in application of the theory, the factors are not identified properly. Then similar to the capital asset pricing model, the unique effects are independent and will be diversified away in a large portfolio, which is sometimes we should also use in the arbitrage pricing theory case. Arbitrage pricing theory assumes that in equilibrium the return on zero investment or zero systematic risk portfolio is 0 when the unique effects are diversified away, because there is no risk, there would be no return. So, it is not possible to diversify the systematic risk. So, if you assume that there is no systematic risk in a particular portfolio or a particular asset, then definitely we can assume that there is one 0 return in this particular portfolio. That is why the expected return of a stock is basically of an asset basically expressed as this. Then this lambda 0 is basically the expected return of on an asset with 0 systematic risk, where already we know that it may be 0. Then the lambda 1 is equal to the risk premium related to the each of the common factors. For example, the risk premium related to interest rate risk, or the risk premium related to the inflation risk, or the risk premium related to the growth rate. Then the B I represents the pricing relationship between the risk premium and the asset, and that how responsive asset I to the common factor k. So, this is basically the model what we formulate to establish the arbitrage pricing theory in a regular phenomena, or what we can say that we should take care of this arbitrage pricing theory case, or very minutely we should identify the actual variables which could have the impact on the expected stock return. You take the example of a two factor model. Let the lambda 1 is change in rate of inflation. The risk premium related to this factor is 1% for every 1% change in the rate, that means lambda 1 is equal to 0.01. If a percentage growth in the real GNP, let lambda 2, the average risk premium related to this factor is 2%, that means for every 1% change in the rate, there is a 2% increase in risk premium, that is why it is lambda 2 is equal to 0.02. The rate of return on a 0 systematic risk asset, that means 0 beta is 3%, that means that is your without any kind of factor if the return is changing, that means that is your this part which is basically your RF or systematic, there is no risk involved in this. So, that is why we call it let this is 3%. So, then what we can find that another asset is rate two stocks in a two factor. Let the response of asset x to the change in rate of inflation is 0.5, the response of asset y to change in rate of inflation is 2, the changes in growth rate is 1.5, the response of asset y to the changes in growth rate of the GNP is 1.75, then it is 1.75, it is for one stock, it is for second stock. For stock 1, it is a two stocks and two factor model. Therefore, the beta x 1 is 0.5, beta y 1 is equal to 0.5, beta x 2 is equal to 1.5, but b y 2 is equal to 1.75. Then, how this model will look like? The expected return already we know that the E I is equal to lambda 0 plus lambda 1 b I 1 plus lambda 2 b I 2. That means, it will be 0.03. 0.03 is this one, which is the 3%. 3%, which is basically talks about the 0 risk level, or we can say without any kind of factor there is a change in returns, that is why we call it the risk free rate of return. Then we have 0.01 b I 1 plus 0.02 into b I 2, because this is the responsiveness to with respect to lambda 1 and lambda 2. Then this will be your E x is equal to b I 1 is equal to 0.05, 0.5, then b I 2 is equal to 1.5, then expected return from the stock x is equal to 0.065 or the 6.5%. So, like that if you talk about E y, the expected return from the stock y, that will be again 0.03, which is same for both the assets or both the stocks, and 0.01 which is your lambda 1 and b I 1 is equal to 2 and b I 2 is equal to here also 1.75, then the expected return from the stock is 8.5%. So, in this way basically the responsiveness of change in particular stocks due to the change in this B I 1 and B I 2, these are basically the factors which basically affect the expected return of the stock, and the coefficients which basically regression coefficient which indicates the responsiveness of these particular factors towards the expected return of the particular stock. There are various studies which have used this arbitrage pricing theory, and what is the result they found. First study is a very famous study given by Roll and Roche. What is the methodology and what is the results they found? That first they said that they estimate the expected returns and the factor coefficients from the time series data on individual asset returns, and use these estimates to test the basic cross sectional pricing conclusion implied by the APT or arbitrage pricing theory. And the authors concluded that the evidence generally supported the arbitrage pricing theory, but acknowledged that their tests were not conclusive. What basically here the Roll and Roche is trying to say? You see that we have certain, we have 1 month return data with us, 1 month return data with us, and we have let 5 stocks or 50 stocks. So, what basically the Roll and Roche was trying to say? They said that for each stock you calculate beta and other variables for all the 50 stocks in 1 month. What does it mean? You take 1 to let you have 30 returns we have, then we regress it with there are different variables. We have inflation, we have this is your return, inflation, interest rate, then we have GDP, etc. Then if for each stock, for stock 1, you take all those 30 days data and regress it, and after doing the regression you will find the coefficients for inflation, interest rate and GDP. And after that what you can do, by that you will have the 50 data points, 50 data points for each stock and for each coefficients, and whatever way we have done the calculation previously, then these 50 data points for each stock, what we have calculated about the inflation, about interest rate, about the GDP, then use it in the second step and see how the expected returns are calculated. And what is the conclusion they found? They found that the expected return will be calculated, and as well as out of them they can say which variables are statistically significant, to determine the expected return of the stock, statistically significant to determine the expected return of the stock, that we can get it from here. But Roll and Roche have concluded that to some extent they found the support for the APT or the arbitrage pricing theory, but they said that their tests were inconclusive, or we can say it is not conclusive. It is because that maybe some sort of other mechanism has been left out from there, and in the further studies those answers will be given by the multi-factor pricing model. Then to do this, some other people have extended this analysis. Out of them, the famous analysis has been made by Cho, Elton and Gruber, who examined the number of factors in the return generating process that were priced, and another is Drimes, Friend and Goltkin re-examined the techniques and their limitations and found the number of factors varies with the size of the portfolio. So, basically this DFG have re-examined the different techniques which are used to test this arbitrage pricing theory, and they said that if you increase the number of stocks in your analysis, if you increase the number of observations in your analysis, then the results will be different, and you will find that varieties of results on the basis of the data what we are going to use. So, in this context what you can say, it is not only the financial variables or financial factors which may have the significant role. Sometimes whenever we make these studies practically or academically, we can find that sometimes the result varies depending upon the data set, depending upon the number of years what we have taken into account, and as well as we have also the number of data points. That means, how many assets have been included in our analysis and how many stocks we have taken into account. These have also played the significant role to decide where to get this particular significant factors which could have the important role for determining the stock return. That is why those part also should be taken into account whenever we go for calculating or testing this arbitrage pricing theory. Then which are the problems here? Some people said that already I told you there are some factors which has not been taken into account in the arbitrage pricing theory. Out of them is firm specific factors. Somebody said that the size of the company basically will have the significant role for determination of the expected return of a stock. So, whenever they have incorporated the size, or we can say this Ren-Ghanem has made this study, there is said that the small size effect, the results inconsistent with the arbitrage pricing theory. That means, whatever assumptions and whatever implications the arbitrage pricing theory was trying to explain, these are not consistent with the small firms whenever we take into account. Chen also supported the APT model over CPM because it is a better model, it is a more comprehensive model, and what CPM model was trying to answer, the APT model is overcoming that thing, and more factors have been incorporated and more analysis have been made, and that is why what you can say if it is a better model according to Chen. And in USA particularly this part is possible in the January anomaly, because you will find lot of discrepancy between the January and the December, because their financial year starts with January and end with December, and to get this some tax rebate, most of the investors basically do not keep the stocks in the December, and that time the price goes down, and January again whenever they buy these stocks in a particular heavy amount, the prices goes up. So, that is why there is unusual behavior we always see, or some kind of unusual price pattern always we observe in these two periods. In Indian context you may say it is April anomaly, because we have the different, but it is not that much significant or consistent in the Indian context to whatever way it is applicable in the US context. So, in popular in the financial literature we refer it to the January anomaly. So, whenever this January anomaly has been taken into account, they found that this Goltkin found that APT not better than CAPM. They said that if you consider the January anomaly into the consideration, maybe beta is the sole factor which affect your stock return, it is not the other factors. That is why they said that CAPM is a better model than the arbitrage pricing model. Then the Burmester and McLary, they found that the effect not captured by the model, but still rejected CAPM in favor of APT, That means, they were favoring APT over this CFA model, and they said that it is not the anomaly which is reflecting that particular impact on this model. Then this, there are other people who are challenging the testability of this APT theory. The Sunkins challenge to testability of the APT, if you refer what they say, what is said that if returns are not explained by a model, it is not considered the rejection of a model. However, if the factors do explain returns, it is considered the support. Then APT has no advantage because the factors need not be observable. So, equivalent sets may conform to different factor structures. Empirical formulation of the APT may yield different implications regarding the expected returns for a given set of securities. That means, empirical formulation modeling basically also is important consideration we should take into account whenever we are using any kind of theoretical models in the finance literature. So, thus the theory cannot explain the differential returns between the securities, because it cannot identify the relevant factor structure that explains the differential returns. Why this differential returns will be there, and why this factor gives 8-point return, another factor gives 10-point return, that identification is quite important whenever we are using this kind of models to identify the factors which affect the expected return of a particular asset or particular stock. So, it is the more task, or it is more logical to identify those things as compared to the other variables. So, that is why this other things we should consider whenever we talk about the alternative testing techniques. Whatever we have the Jobson purposes another technique which is called APT testing with a multivariate linear regression model. Brown and Winston purpose using a bilinear paradigm, but more or less if you conclude, or if you want to say something about the advancement of APT, this is basically this multi-factor pricing model, and the multi-factor pricing model basically talks about the different factors which affect the key role, which affect the expected return of a stock in a particular framework. So, if you consider those factors, if you take into account those factors, and you can make a comprehensive view, comprehensive study to formulate that, taking into account both the firm specific, industry specific factors as well as the macroeconomic factors, and make a linear formulation or the nonlinear formulation, maybe it will have the better reflection, it will have the better prediction of the expected return than the normal APM or the CAPM model. So, we will be discussing this multi-factor pricing model in the next session. Thank you.